All right, let's give it. Well, I guess we're past time. So sorry, I was running from another webinar and just came in here. But anyway, thank you guys for joining. I appreciate it. We're going to talk a little bit about our global best ideas, and we're really going to talk about how we can use those global best ideas to make investment decisions that are right for us. But before we get started, anything you hear today is, of course, general advice. I don't know anything about you, so I can't offer personal advice, but questions would be great. So send through some questions as we go through this, and I'll spend some time talking about them. But really, what I want to do is use our research today as context to, of course, making decisions. And I know that as we approach end of financial year, there are a lot of people that are looking at their portfolio and looking at what are opportunities going into the new year based on how we certainly view markets and the conditions that we see things, and how you can make great decisions for the next year. So let me first go into our global equity best ideas. So I'm just on the homepage of our Morningstar Investor product. So I'm going to go into stocks, and then I can very simply go down and look at the full list of our global equity best ideas. So just as a refresher for people who do not know what our global best ideas are, on a monthly basis, our analysts go through and they look at all of the 1,600 shares that they cover globally, and they come up with, as the title would suggest, their best ideas. But just because it's the best idea, just because something's on the best ideas list from our analysts, doesn't necessarily mean it is right for any of us as investors. So that's what I want to spend a little time talking about. So what you can see is on June 1st, of course, we came out with this latest list, and then we will refresh this again on July 1st. And there can be a couple different things that go into the decision that our analysts make, whether to include something on this list, but a lot of it's very valuation driven. And we can certainly talk about that. But first, before we go into these best ideas, I do want to take a step back and look at the overall economic environment that we are facing. So for anyone who just tuned into our webinar with Dan Kemp, who is our global chief financial officer, he spoke a lot about the economy and the current environment that we're into. But I just wanted to share a couple thoughts that I've heard a lot of investors discuss, and we can go from there. So very quickly, what are some things that, of course, we are reading about in the papers every day, and how could this potentially inform how we want to position our portfolio? But couple caveats before we go into this. We want to be very careful as investors that we are not continually changing our portfolio. So, of course, we are in an environment where we're inundated by news, we're inundated by data, all of the mechanisms that we have to disseminate data now, of course, mean that it's constantly in your face. So whether that's the internet and social media and every other thing that we're looking at every day can create a very difficult environment for investors to function in, and a very difficult environment to resist the urge to continually try and position your portfolio for what you think is going on. So I did want to take a step back and look at a couple things that we've talked about a couple times on here, but that do characterize the economy right now. And then we'll go back to that best ideas list and look at how different securities within that play into these themes. So, we obviously have faced elevated inflation, and certainly elevated inflation from anything that we've seen within our investing perspective back to the early to mid 80s really was the last time that we saw significant levels of inflation. Now, there is certainly a school of thought that we will be in a prolonged period of elevated inflation. So not necessarily as high as what we're seeing right now, but certainly above what many investors have experienced for a very long time. And even if we settle into inflation in the 4%, certainly 5% range, that is significantly higher than what we've seen. And so as investors, we need to think about inflation and think about the impact, particularly if we are investors going out there and buying individual shares. We want to think about what that impact is on companies. Because remember, over the long term, what we are doing as an investor, and many things can influence prices in the short term, but as a long term, we're buying companies. And ultimately, we want to own companies that will thrive in whatever economic environment we have. So if we think about inflation and what's happening with inflation, so we obviously went from this period where everyone was saying it was transitory to very quickly everyone realizing that no, it's not in fact transitory. It is entrenched in starting to get more entrenched into the economy. And initially there was a lot of unity that inflation was something that we needed to combat. And you did see this unity between central banks and, of course, governments. It does appear that that is beginning to break. So if we go back and we look at a lot of the stuff that's happened in Australia, we seem to start to see this break from politicians who obviously have a big say in government spending and other things that influence the economy. And then, of course, central bankers. So, if we think about inflation overall, what is the initial reaction? Well, the initial reaction by everyone is that if we're going out there and it costs us more to go to Kohl's or Woolies or out to dinner or to rent or purchase a house, obviously, people that are still employed are trying to get this increase in the cost of living. They're trying to offset that by increases in salary. So people obviously do that as sort of lone actors going out there and talking to their employees. But we're also seeing that through mechanisms such as any sort of collective bargaining that's involved with groups of employees. And while central banks continue to raise interest rates, or at the very least pause and indicate that they're going to continue to raise them, we've seen that kind of political will deviate from what central banks are doing. I guess we've seen a lessening of that political will, and it's very simple, right? Politicians obviously want to be reelected, and the things that we do to fight inflation generally don't really help you get reelected, right? To fight inflation, we are trying to slow the economy. We heard a lot of talk about inflicting economic pain, and that may sound great if you are a central banker and sitting in a little bit of an ivory tower and looking at the overall economy and understand the impacts of inflation over the long term. That's a pretty bad deal if you lose your job because the economy is slowed. It's a pretty bad deal if you own a house and you're forced to pay more for that house with continual increases in interest rates. So we saw a little bit of this around the recent increase in minimum wage, where there are some differences of opinion, certainly from politicians and the levels of increase and central bankers. And we're seeing this all over the world. And this is not the first time this has happened. So famously, back in the 70s, there was a break between central banks and specifically President Nixon in the US, who really did not want to see the economy slow at all in the 70s as he was going through his reelection bid. So we do see that. But as investors, well, we can watch that fight going back and forth. If we believe that inflation will stay elevated, we need to understand the impact that that actually has on companies. And the real impact that we have to understand is over the very short term, a lot of times consumers and companies will also face high inflation. Well, I guess for a non-articulate way of describing it, will kind of suck it up or not notice. But over the long term, what this is going to do is it's going to change all these relationships that we have in economies. And we have to remember that relationships, of course, exist all along the supply chain for companies. So if you are producing a good and you're going out there and buying various inputs into whatever you're creating as a company, if you're paying employees to work for your company and you're seeing wages go up, you're seeing input prices go up, you do see a fight across the supply chain to try to make somebody else eat this inflation so that you don't have to. So that can be pressuring your suppliers to not raise prices. That can be certainly changing the size of your workforce or not giving your workforce raises that indicate that make up for what's going on in the economy. So we have to understand that that's incredibly disruptful for companies. And it's also really disruptful to the relationships between business and consumers. So as I said, over the short term, maybe you won't notice those initial increases in inflation. But at a certain point, what it's really going to do is it's going to change your buying patterns. Oh, did I screw up the slide? Slide page 2 says elevated valuation levels indicate lower, not just, I will get to that. So sorry about that. And so what we're seeing is, of course, differences as consumers go out and either substitute cheaper goods or forego buying certain goods or buy less of those goods. So really, this is very disruptful for companies. So if this is something that we see going forward, one thing that we can focus on, of course, is companies with sustainable competitive advantages. And that, of course, is reflected in the moat rating that Morningstar Analyst put out. That is in our global best ideas list, which we will get to. So that's one thing we can do. The other thing we can talk about is uncertainty or business risk. And really what we're looking at is the risk to the future cash flows that a company generates. So some companies have very high business risk. Some companies have lower business risk, and that's reflective of the company, the levels of debt they may have, the industry they operate in, the power that they have over pricing. And that power is both their ability to set prices and their ability to raise those prices without losing a significant amount of market share. So we'll talk a little bit about moats. And we'll talk about our uncertainty rating or the business risk or risk to those future cash flows. The other thing, of course, we need to look at is we, of course, have seen higher interest rates, and we're applying those to a surge of debt that's been accumulated post-GFC and then certainly during that COVID period as well. So that's debt that's been taken on by individuals. That's debt that's been taken on by companies. That's certainly debt that's been taken on by governments. And all things being equal, of course, it costs more to service that debt in a higher interest rate environment. And those impacts will continue to be felt because it does take a little time, of course, for that to pass through the system. Floating rate, we see it happen almost immediately. But even fixed rate bonds that are issued by governments and companies, et cetera, that will reset at a certain point once it matures. And if it's resetting right now, you're going to be paying more for that debt. So we do need to realize that's going to impact from a company perspective. It's going to restrain earnings and the cash flow that's generated. And it's also going to make it more difficult. We talked a lot about the easy money era. That's a term that's been thrown around a lot where interest rates were very low when obviously a lot of debt was being taken out and there was more spending, but it was relatively easy to get money at the end of the day. And there are some signs that potentially that era is coming to an end, which you would expect with higher interest rates and investors a lot more focused on valuation levels. So we do need to take that into account. And really what we're looking for, if we want companies that will thrive during this period, is we want people that can internally fund what they are doing. And that's basically just generating cash flow out of your operations to continue to go out there and invest in the business and deal with this evolving area. So here's the last point, which I think is what Michael has pointed out. Okay, so it's actually a question. Sorry. Apparently I can't read. So the last point, then I'll get to Michael's question, elevated valuation levels. And inflation historically, and I'll talk about both of these, may indicate that we have a lower return environment ahead. So let's break both of these down. So number one, from a valuation perspective, we need to remember that And in this webinar, I just went through, I think Dan Kemp, who's our chief investment officer, he put it a little differently than perhaps I would, but you should definitely listen to him. But either way, there's, sort of agreement if you go out and look at valuation levels that we have seen valuation levels come down, but certainly the market in general is not cheap. So it's sitting a little above average from what we've experienced back to 1990. So higher valuation levels do lead to lower future expected returns. And it's very simple that you as an investor are paying more for every dollar of earnings that a company generates. Well, it's going to be harder, of course, for that company to increase valuation levels, for you as an investor to benefit from those increases in valuation levels if things are not cheap. And that takes a little bit away from returns. The other thing we need to think about is the historical impact of inflation on returns. And very simply, and there's a great piece that Ashley Owen put together that we published in First Links, and very simply, every asset class, every major asset class has performed worse in real terms. So that's what we're focused on as investors, real terms. What is our return in excess of inflation? Almost every single asset class, or I guess every asset class, has performed worse in those years. And I can certainly send that article to anyone who's interested in receiving it. So there are some indications that we could be in a lower return environment going forward because of the impact of inflation and because valuation levels are not cheap. So I think Michael's question, inflation worth differentiating explaining. So I think hopefully I just explained that. But I think there are two different pieces that can give us doubts about returns. Now, very simply, if we're talking purely from a personal finance perspective, what do you do when there's lower returns? Well, either you lower your expectations for the future, you save more money, or of course, you delay when you want to achieve your goal. So if we can put this within the retirement context, is how can I address lower future returns? Well, if I'm approaching retirement, one thing I can do is, I need to save more. I could push back that retirement so that I have longer to save and invest before I start using my portfolio to fund my life. Or of course, I can lower my expectations in retirement. And if you are in retirement, we need to think about from a return perspective what it means. Well, it means that potentially you should go back and revisit the amount of money that you're withdrawing from your portfolio. And I certainly understand that there are guidelines from the ATO, there are requirements from the ATO on how much you need to take out. But just remember, you don't have to spend that. And if we are worried about returns into the future, we do need to be cognizant that, okay, a lower withdrawal rate, spending less, lowering your expectations is a way to make your portfolio last longer, because that, of course, is what you are worried about. Okay, so Alan said, I'd like to receive Ashley Owen's article. If you could just email me at mark.lamonica1@morningstar.com, I will shoot that to you. So thank you, Alan. All right, so how does this all play in? The first thing I would say is, number one, it doesn't mean that any of this stuff, because I put it on the slide, is necessarily what is going to happen. For all we know, inflation could fall significantly, interest rates could be cut significantly, all sorts of things could happen. But I just wanted to use this scenario as a basis, whether you believe it's going to happen or not, as a basis to go and look at a couple shares in our global best ideas. So let me go back to that, and we can try to pull out a couple examples. So a couple things to note. We do have some high-level ratings on here. I'll very quickly go through those. And then what we also have is we have our analysts presenting a little bit of a short write-up on why each one of these shares is included. And I use InvoCare as an example. So InvoCare is still a publicly traded company. We'll see what happens. It's, of course, received this buyout offer that has been accepted by the board, still needs to be approved by shareholders, a couple other hurdles to jump through. But yeah, it's just an example of the write-up that our analysts do, and then you can go to the full company profile. But a couple different things and how we want to look at these. Okay, so and how we can think about how our goals can influence what securities we actually buy. So first thing we focus on this Morningstar rating, that is a valuation level. So of course, shares that we believe are trading at a discount to what our analysts believe they are worth, you get more stars. So generally anything that is 4 or 5 stars, we would say is undervalued. Valuation is very important. So very important to the returns you get going forward as an investor. So that's the first place you can look, of course, at valuation. We talked about economic moat. Now, this very much goes into, and certainly how Morningstar views the world. Remember, economic moat represents this sustainable competitive advantage. And what this means is that incrementally over the years, we expect companies to earn returns that are in excess to their cost of capital. So very simply, that means they can go out there, in a simplistic example, they can go out there and borrow at 5% and fund their business by borrowing, and they can invest back in the business and earn 6%. And I deliberately picked 2 numbers that were pretty close together, because what we have to understand is that the benefits of a sustainable competitive advantage occur over the long term. So really what we're doing is we're talking about, even that 1% does not seem that much, but as we compound that over years and years and years, economic moat becomes more important. And so really what I'm saying about economic moat is that this is a long-term investment strategy. If we're going out there and trying to find companies with a sustainable competitive advantage, we have to realize that over the short term, a lot of different things are going to drive those security prices. Over the long term, the company should benefit from having this sustainable competitive advantage. So the first thing I'd say is that if you're really looking for these companies with sustainable competitive advantages or moats, make sure that you're focusing on the long term. If you are a short-term trader, which of course we are not advocates for here at Morningstar, this matters less. It's going to matter more than is just the supply and the demand that impact markets, surprises ahead around what happens economically globally and what happens with company results versus the expectations that are baked into the market. The uncertainty rating. So this is the other rating I was talking about. So remember, this represents the risk to the future cash flows that are generated by a company. And of course, the ability of you as an investor or an analyst giving investment recommendations to estimate those cash flows. So the higher the uncertainty, the more varied those business outcomes can be, and potentially the more, and most likely, the more varied the paths of a share could be. So how do we want to use this? Well, if we are investors who are more focused on lowering the volatility of our portfolio, then we'd want to go for medium and low uncertainty rating. Now, why is that? Because the market, and certainly large swings that we have in the market or large swings that we have in an individual share price, is very much based on how that company or the overall economy performs in relation to expectations. So remember, it's not that absolute performance or that absolute number that matters to drive those prices. What really matters is what people think is going to happen and what happens. So what does this mean if you have a low or medium uncertainty rating? Well, it means that there's more insight into what's going to happen to these individual companies. And potentially with a portfolio made up of medium and low uncertainty ratings, we will see less volatility, but we'll also have a smaller range of options. So let's use a couple examples here that we can jump out on. And I know certainly InvoCare is potentially not going to be a publicly traded company for much longer, but let's use it as an example. So what do they do? Funeral homes. So at the end of the day, the funeral home business is pretty boring unless you are, of course, the person whose funeral it is. I guess that would be unpredictability about life. But at the end of the day, what drives profits from funeral homes? Well, it's the death rate, which is pretty easy to predict over the long term. There can be fluctuations that, of course, occur over the short term, but the overall demand for the industry is fairly easy to figure out. InvoCare is a large operator in Australia in terms of they have a big part of the market share through multiple brands in Australia. So we know that they're already an established player. The good thing about being an established player in any industry is, of course, having more market share means that you have a lower range of outcomes, because chances are you're not going to be able to make significant changes in that market share, both good or bad. So we've got a company that has a pretty predictable demand, has a lot of market share. So we're not going to see a lot of changes in there. In terms of pricing, at the end of the day, funerals are, well, it's not a one-time expense. I guess you can be paying for lots of people's funerals. But at the end of the day, a funeral is something where people are not that price sensitive. At the end of the day, they think of it as a singular event, one that they actually want to spend some money on. So there's some predictability around pricing as well. And all of those factors, including the fact that our analysts believe that InvoCare is in fairly good financial shape, doesn't have a lot of debt, so not as impacted by some of the things that having high debt can do, we give it a medium uncertainty rating. So that's very, very different from some other companies that we see on here. So certainly if we look one above it and we look at Fineos, so they are a company that builds software for insurance companies that has very small market share, is not profitable. We like their prospects. We think that they will gain market share. But once again, there's more unpredictability around going out there and winning a significant amount of market share with a relatively new product that that's trying to get into this industry than something like InvoCare that does have a large market share already of the funeral industry. So Fineos is a very different share, very different than someone that would invest in InvoCare. Now, you can have both in your portfolio, certainly, but the upside of a company like Fineos is probably a lot higher than the upside of InvoCare. Just like the upside to a startup technology company is very different than Microsoft, which is a huge global player that dominates the market. Now, at the same time, while there's more upside in Fineos, there's also a lot more downside. So if they're not able to establish themselves, if they're not able to reach this critical mass where they even become profitable, because they're not profitable now, then of course that can be problematic as an investor. It means that you could potentially lose all your money. But it's just a way to think about the different companies looking at this uncertainty rating. And that's the difference between very high and something called medium. So very high is actually not even the highest rating that we have, but certainly higher than medium. We talked about price to fair value. So price to fair value indicates, based on what our analysts believe the company is worth and what it's trading for, indicates how big that discount is. So anything less than 1, of course, we believe is undervalued. Now, what you may notice here, and this is where uncertainty rating comes into play as part of our investment methodology, what you may notice here is InvoCare 0.86 is 14% undervalued. 0.61 means that Fineos is 39% undervalued, yet they're both 4-star stocks. Why is that? Because, of course, if there's more uncertainty around the future and more uncertainty around business outcomes, what we're going to want to look at is what is that margin of safety that protects us from those range of outcomes. So you should have a bigger margin of safety if you're investing in something with very high uncertainty like Fineos versus something with medium uncertainty like InvoCare. So think about your own portfolio. Think about how that uncertainty can impact volatility. And that can be an indicator of whether a share in this case is aligned to the goals that you have for your portfolio. Because if you have a very long time until a goal, maybe you're fine with volatility. Maybe you're fine loading up your portfolio with companies that are more like Fineos than if you were about to retire. So you might be trying to find that kind of lottery ticket return from something in your portfolio if you've got 30 years to go until retirement. Whereas if volatility is really impacting you and how much you can take out every year from retirement, maybe those are not the types of companies that you want to put into your portfolio. So just trying to provide a little bit of perspective on the different holdings that are in this global best idea. So basically what you can see, this is organized by country. And you can go through and search within those individual companies. But I did want to walk through an example of a company that actually is not on our global best ideas anymore, but something that we recently called some focus to. As soon as I figure out how to share my screen again. Sorry, I know this is a perpetual problem for me. Where is this thing? There you go. All right. So we're going to look at AMC, ticker symbol AMC. And we recently highlighted this as an opportunity that finally, as you can see from this first line up here, we'll go through some of the specifics first, finally was undervalued for the first time since May of 2020. Certainly a company that we see as a blue chip in the local Australian market. Now, how did this happen? Is there was a sell-off after a profit miss. And I'll talk a little bit about kind of what happened with that. But one way as investors that we can always look for opportunities is when does a great company hit a short-term hit some short-term issues that do cause sell-offs in the price. First, let's go back and look overall where we are. So a couple of things, uncertainty low, so even lower than InvoCare. And really the reason that the uncertainty is so low is, and at the end of the day, they make packaging. So AMC makes packaging, generally like plastic packaging. So very little exposure to the overall business cycle. So first of all, the companies that they serve are generally consumer defensive companies. So these are companies where people need to buy their products no matter what is happening in the global economy. And so if we divide companies up between cyclical, companies whose fortunes are very much based on what's happening in the global economy, and then non-cyclical, so companies that are always going to be needed by consumers. So think healthcare, think food, all the things you need to sustain your life that you're going to keep buying no matter what. Those are the companies that Course sells to, right? So given the fact that those are their customers means that there's low uncertainty, there's little exposure to the economic cycle. It's a consumer staple company. And so that's one thing we can look at, certainly as we look at, are we going into a recession? Are we not going into a recession? Where are interest rates going to be? Where is inflation going to be? Many consumers will just continue to go out and buy products that are packaged by AMC. So that's uncertainty. Talked about the star rating. So it's only trading at a 6% discount. Then we've got economic moat. Now, packaging is, as you're probably not surprised, has really become a bit of a commodity. So at the end of the day, there are very few things we can differentiate if we are manufacturing packaging for products. There's very few things that we can differentiate from our competitors. So the only real way that you can have a sustainable competitive advantage with a company that is selling something that's either an actual or virtual commodity, the only real way that we can do that is if we can produce it for less. Because there's no other way that we can compete. We can't differentiate the product. We really need to focus on what we can actually sell it for. And luckily enough, AMC actually does have a competitive advantage in terms of how cheaply they can produce things. Now, what this has allowed the company to do, and once again, I'm using an example. I'm not necessarily recommending anyone out here buys this. I'm using this example how you can analyze companies, is that a moat at the end of the day needs to have a real benefit for investors. And I talked about that benefit before, is that really we want to be able to invest that capital, invest any capital in the business and earn a return that's higher than what we are borrowing money for. So really a figure our analysts really like looking at is return on invested capital. So very simply, no matter where you get that capital, whether it's internally generated, whether it is money that you go out and borrow or money that comes from shareholders, what is that return when we reinvest it in the business? And so that's what return on invested capital is. And anyone who's worked in a business, whether it's your own business, whether you are working in a larger corporation, knows that if there's something you want to do, if there's a project you want to undertake, generally what you'll do is you'll go to your boss or you'll go to whoever the decision makers are, whether you will actually go ahead with this project, and you will talk about the return you're going to get. So if I go and build a new factory, what return am I going to earn off of that new factory? And what we've seen with AMC is we have seen a return on invested capital of over 14% between 2013 and 2022. Now, we of course have to go back then and compare that to that weighted average cost of capital, how much it costs for that company to get the money that they're investing in the company. But 14% is really good at the end of the day. So if we go out there and look at, even with interest rates going up, if we look at interest rates, that's exceeding what most companies would borrow at, certainly exceeds the cost of equity, certainly exceeds what you would internally generate and put into the company. So we can really see the impact of that moat. And if we think about this particular business, so if we were talking about packaging, and let's say this company wanted to expand, well, that's going to cost money. You go build a new manufacturing facility for packaging. That's going to cost you some money. What is the benefit? Why are they earning a higher return? Well, they are producing things for much cheaper than competitors. So remember, how that directly plays out is that I have this commodity. Prices are pretty much solid across all the different people who are selling this packaging. Well, if I can make it cheaper, my return will be higher. So I'll have a bigger profit margin. That profit margin translates into a higher return. So that is a good thing for me. Then we've got, of course, what I talked about with dividend yield. So I love dividends. Most investors love dividends, but we do have a pretty strong yield, 4.79% right now. So that yield, of course, went up with the sell-off we saw in those shares, but we want to make sure that that's actually sustainable. How do we look at sustainability? Well, the first thing we can look at, of course, is a payout rate. How much of their earnings do they pay out? Well, they're only paying out 75%. So what does that mean? Well, in a real sense, well, the company certainly wants to use cash to do other things. In a real sense, earnings could fall 25% and they could still have coverage over that dividend and maintain that dividend, because the last thing we want is dividend cuts. Also, we want to look at cash generated by the company. So over $1 billion a year in free cash flow is generated by the company. What free cash flow means is it means after we've gone out there and paid all of our operating expenses and paid all our capital expenditures. So an operating expense is, what does it cost on a day-to-day business to run this company? What are the salaries I have to pay? What are certainly the costs, other costs associated with manufacturing what I sell? After covering all those costs and after covering capital expenditures, and the capital expenditures simply when a company is making an investment in itself. So going out there and spending money to build a new factory, for example, that's a capital expenditure. Once they've gone out and done that, they're still generating $1 billion a year. And we like free cash flow as investors because that's what we get to keep. And it might not be given to us, right? But at the end of the day, after all the expenses associated with operating a company and after the expenses associated with those capital expenditures to grow the company over the long term, we still have $1 billion. And what can the company do with that $1 billion? Well, they can do ultimately anything they want, but part of it is they can return it to us as shareholders. They can also use it to go out there and buy another company. They could buy a bunch of company jets if they wanted, but we're obviously hoping they're making good decisions. But that's an opportunity that they can return that to shareholders. So we've got a question from Scott. So Scott says, hey, Mark, does the emphasis on dividends mean we should transition from the US to AU frank shares in this environment? Okay, so it's a really good question. So let's talk about franking for a second, and we'll talk philosophically about how franking impacts us as investors. So franking, of course, boosts the total return that you receive as an investor. And franking, of course, only happens if you are an Australian investor or investor in Australia investing in Australian companies. So really what franking is it's dealing with the double taxation associated with dividends. And the double taxation comes from the fact that if I'm a shareholder, I own the company. The company that I own is paying taxes on the profit. And then as soon as that company gives a portion of that profit to me, I get taxed again, of course, right? Because you get taxed on dividends that come in. So this is double taxation, ultimately. Now, there's a lot of people that argue, tough luck, that's what shareholders should just have to deal with. And in a lot of other countries, they do. But in Australia, franking gives us the opportunity to actually get those taxes that the company that we own applied to the taxes we have to pay, and they do that by issuing you a franking credit, which has a tax benefit for you. So that's franking. So basically franking at the end of the day, only Australian shares, it boosts those returns of Australian shares. So what I would say, the answer to your question, Scott, is all things being equal, we of course would rather have franking than no franking. We'd rather invest in companies that are 100% franked. We would rather put all of our investments into companies that are 100% franked. The issue that we run into, of course, is that like any tax policy, this distorts the market. And some people argue that Australian companies focus too much on dividends because of this benefit from franking. They don't invest enough in the company. And because they don't invest enough in the companies don't grow. The other issue we run into, and we've seen that, by the way. So if we go back and we look at dividend growth, Australian companies pay, compared globally, pay a higher yield than we see in almost every other country globally. But if we go back historically and look at dividend growth has been faster in the US, for example. There's less emphasis on dividends. A payout rate of 75%, well, certainly not unheard of. It's kind of what we get in Australia, 75% and up with most companies, meaning 75% of profits are paid out in dividends. In general, the payout rate in the US market, for example, is much lower. So what that means is if you pay out less in earnings, you have more cash to put other places. One of those places could be investing in the company. And that's why we've seen faster dividend growth in the US versus Australia. Now, and I'll talk about the last distinction in a second, where we want to see if this fits into our portfolio. So if I am an investor that has a very long time horizon, that faster dividend growth matters more for me, right? Because that will compound over a very long time. If I have a shorter time horizon, if I am retired, for example, or I'm older and getting closer to my goal, well, then what's more valuable to me is not that growth. What's more valuable to me is a higher current dividend, right? That I don't have as many years for that growth to overtake the higher dividend. I don't have as many years for that growth to overtake that benefit from franking credits. So I think those are some important considerations just looking at the dividends. The other thing, of course, we have to look at is we have to look at the Australian market and see it for what it is. So the Australian market is relatively concentrated within certain industries. The Australian market is very domestically focused. If we look at percentage of revenue that companies make, and we can just see that with the big companies in Australia, right? So kind of putting the miners aside who make all of their profits selling globally, if we sit there and look at financial services, for example, tick off the big four banks, all very domestically focused, meaning their operations and the money they make is in Australia. The money they don't make in Australia is generally from New Zealand. And companies like Telstra, very domestically focused. So I think it's just important that we realize there's a bigger opportunity set in global markets. So certainly if something goes wrong with financial services and mining at the same time, the Australian market is in a lot of trouble. So I think there are other considerations, but yeah, all things being equal, franking credits is a benefit. It is why our investment management team does believe the Australian market right now, given valuation levels, does have higher, longer-term expected returns than the U.S. market, for example. Now, that can obviously change if U.S. valuation levels come down, but that's their view right now, and that difference is largely the benefit of franking credits. So hopefully that helped a little bit. Okay, so Scott says, and this is a good one, once AMC reaches fair value, does that mean we should sell and look for other than 4-star and 5-star companies if ignoring the dividend payment? Okay, well, so let's talk a little bit about this, when you should sell. Now, I'll obviously give my own point of view. What we want ideally as investors is never to sell. And the reason we don't want to sell, and Warren Buffett has 500 quotes about this, my optimal holding period is forever. I don't care if the stock market closes for 10 years because I'm not selling. I just want to own these businesses. But the reason for this is, number one, selling does bad things to us. Selling, and there's some exceptions depending upon your tax circumstances. If you're supers and pension phase, there's always exceptions. But in general, selling causes taxes. So as long as you're actually a decent investor and the things you bought have gone up, selling means taxes. Taxes are bad. We don't want to pay taxes. I'm not saying they're bad in theory, but I'm saying we want to minimize our taxes as investors. Selling generally induces that. The other thing, of course, you do pay transaction costs. So if we sell too much, we're all of a sudden paying lots of transaction costs. So that's not only the brokerage fee, buying and selling something, it's also that bid-ask or buy-sell spread. So the difference between what you buy something for and what you can sell it for. And, the difference between that is what people are making money off of that are the intermediaries in the market. So those are both bad things. So that's one reason not to sell, even if something goes up to what we would consider a fair valuation level or potentially even overvalued. The other reason, of course, is that we need to make sure, and our analysts will always have, obviously, shares that trade at or shares are rated at different valuation levels. So always be opportunities out there, but we need to make sure we're picking the right one because of course our analysts are human. Humans make mistakes. Our analysts are trying to forecast things out into the future. The future is unknowable. There's all sorts of issues, of course, associated with going out and continually turning your portfolio. But the big one is, how do we know that something's actually a better opportunity? And as investors, we do need to be cognizant of the fact that we're really bad at this. So there have been countless studies that have done looking at brokerage account data and finding that investors continually sell stuff that does better after they sell it than what they purchased. And a lot of that is because as investors, we have this natural tendency to chase performance. So yeah, I would not use in any way our ratings on a share as a mechanism for trading your account. For all we know, AMC could be fairly valued in a couple of days from now. Do we really want to buy it today, sell it in a couple of days? No, not in my viewpoint. So I try to hold things for very long periods of time. And if they certainly move up into a valuation level that is overpriced, I'll sit there and look at it, but I generally won't sell anything unless I think that the thesis I have behind this company has changed. So hopefully that helped a little bit. We have, yes, Phil's saying zero franking on AMC dividends. More like AMC analysis would be great. This analysis would be a great type of presentation workshop next ASA conference. Yeah, well, that's good. Okay. Apparently people like me actually going through this, but unfortunately we don't have enough time to go through another company, but I can certainly do this more in the future. So that is good feedback. So because we don't have time and I've been talking for 2 straight hours, I might leave it there. But if you have any questions and if there's any specific companies that our analysts cover that you want to know about, I can send through those analyst reports and, we can look at the different components that would influence a decision that you are making. Phil says WDS next time. Okay. I think we can do that, Phil. All right. Well, I'm going to leave it there. But anyway, thank you guys very much for joining. I really appreciate it. And I will see you all soon.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.